Good day, investors. In this video, we will take a closer look at Ares Capital stock, ticker symbol ARCC. This company has historically been known for paying very attractive dividends, and it has built a strong reputation among income investors over the years as one of the largest and most well-established business development companies in the market. But the big question investors are asking right now is this: is Ares Capital still a safe dividend stock, or are the risks in private credit starting to grow? In this video, we're going to break down the business model, the financials, the dividend safety, and ultimately answer the big question: is Ares Capital stock a buy right now? But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. Now first, let's quickly talk about what Ares Capital actually does, because understanding the business model is very important before investing in this stock. Ares Capital is what is known as a business development company, or BDC. In simple terms, the company provides financing to middle market businesses, which are companies that are typically too large for small bank loans, but often too small to easily access public bond markets. Instead of borrowing from banks, these companies borrow directly from lenders like Ares Capital. In return, Ares earns interest income on those loans, which becomes the primary source of revenue for the company. And because BDCs are required to distribute most of their earnings to shareholders, a large portion of that income is paid out as dividends to investors. This is why stocks like Ares Capital are often popular among income investors who are looking for high dividend yields. Looking at the size of the company today, Ares Capital has built a very large and diversified investment portfolio. Now let's quickly look at the financial highlights. In the fourth quarter of 2025, Ares Capital generated about 50 cents per share in core earnings, while net investment income came in at roughly 52 cents per share. For the full year, the company produced about $2.01 per share in core earnings, showing that the business continues to generate strong income from its lending activities. Another important metric is net asset value, which currently stands at about $19.94 per share and represents the underlying value of the company's investment portfolio. The size of the portfolio is also quite impressive, as Ares Capital currently manages around $29.5 billion in investments, making it one of the largest business development companies in the market. Now, when we look deeper into the investment portfolio, another important factor to consider is diversification. As we can see on this slide, Ares Capital's portfolio is spread across more than 600 different portfolio companies, which helps significantly reduce risk. In fact, the top 15 investments represent only about 25% of the total portfolio, while the remaining 75% is spread across hundreds of other companies. This level of diversification is important because it means no single borrower can have a major impact on the overall portfolio performance. In other words, even if one company experiences financial difficulties, the impact on Ares Capital's overall portfolio would likely remain relatively limited. Now let's take a closer look at how the portfolio is structured, both by asset class and industry exposure. Starting with asset classes, the majority of Ares Capital's investments are in first lien senior secured loans, which make up about 61% of the portfolio. These loans sit at the top of the capital structure, meaning they have the highest priority for repayment if a borrower runs into financial difficulties. The rest of the portfolio is spread across second lien loans, subordinated debt, preferred equity, and other equity investments, providing additional diversification and return opportunities. Looking at industry exposure, the portfolio is also well diversified across many sectors of the economy. Some of the largest sectors include software and services, healthcare equipment and services, and commercial and professional services, but no single industry dominates the portfolio. Overall, this diversified structure helps reduce risk and provides multiple sources of income across different sectors of the economy. Now, when trying to evaluate the safety of Ares Capital's portfolio, it is important to look at the credit quality of the companies the firm is lending to, because this gives us a better idea of the underlying risk. As we can see here, the average EBITDA of the portfolio companies has remained relatively strong, increasing from about $289 million to over $307 million over the past year. This suggests that the companies Ares lends to are generally large and established businesses, rather than small or highly speculative borrowers. At the same time, the average net leverage ratio has remained fairly stable at around 5.6 times EBITDA, which indicates that overall debt levels in the portfolio have not increased significantly. Another important metric is the interest coverage ratio, which currently sits at about 2.2 times. This means that, on average, the portfolio companies generate more than twice the earnings needed to cover their interest payments, which provides an additional layer of safety for Ares Capital. Another important metric to monitor when evaluating the risk of a BDC is the level of loans on non-accrual status. Non-accrual loans are loans where the borrower has stopped making interest payments, which means the lender is no longer recognizing income from those investments. As we can see on this slide, Ares Capital's non-accrual rate has remained relatively low and fairly stable, at around 1.8% of the total portfolio based on amortized cost. On a fair value basis, the number is even lower, at roughly 1.2% of the portfolio. Overall, these levels remain relatively modest for a private credit lender, which suggests that the vast majority of the loans in Ares Capital's portfolio are still performing as expected. Now, of course, the main reason many investors are interested in Ares Capital is the dividend. Ares Capital currently pays a quarterly dividend of about 48 cents per share, which translates to roughly $1.92 per share annually. At current share prices, that represents a dividend yield of around 10%, which is significantly higher than the broader stock market. However, when investing in high-yield stocks, the most important question is always whether the dividend is sustainable. Looking at the company's earnings, Ares Capital generated about $2.01 per share in core earnings during 2025, which means the dividend is fully covered by the company's income. Additionally, the company currently has about $988 million in undistributed taxable income, which can be used to support future dividend payments even further. So why has the stock declined recently? Well, a big reason is that investors are becoming more cautious about the broader private credit market. Over the past decade, private credit has grown extremely quickly, and some analysts are beginning to question whether too much capital has entered the space, potentially leading to looser lending standards. Another concern is liquidity risk. Unlike publicly traded bonds, private credit investments are not very liquid. That means if a large number of investors suddenly tried to redeem their money at the same time, some funds could be forced to sell assets in order to meet those withdrawals. In extreme scenarios, this could create temporary price pressure across the private credit market, especially if loans have to be sold quickly. Investors are also watching interest rates and economic growth. If the economy slows down, some middle market companies could struggle with higher borrowing costs, which could increase default risk in the loan portfolio. Because Ares Capital operates directly in this lending market, concerns about these broader risks have caused some investors to become more cautious, which is one reason the stock has pulled back recently. However, so far the company's actual portfolio performance still appears to remain relatively stable. So with that in mind, the next question investors should ask is whether the recent sell-off has created an attractive valuation opportunity. Looking at the current price, Ares Capital is trading at around $17.86 per share, which is actually close to its 52-week lows. The stock has declined significantly from its recent highs above $23 per share, reflecting some of the concerns investors currently have about the broader private credit market. Right now, the company has a market capitalization of about $12.8 billion, and the stock is trading at a price-to-earnings ratio of roughly 9 to 10 times earnings. For a company that generates relatively stable lending income and currently pays a dividend yield of around 10%, that valuation could appear relatively attractive for income-focused investors. Another interesting point is that analysts currently have an average price target of around $21.60 per share, which would imply roughly 20% potential upside from the current price. So overall, what's the final verdict on Ares Capital stock? In my opinion, Ares Capital remains one of the highest quality BDCs in the market. The company has a large and diversified loan portfolio, strong dividend coverage, a long history of consistent distributions, and an experienced management team from Ares Management. At the same time, the stock is currently trading near its 52-week lows and slightly below net asset value, which could potentially offer a more attractive entry point for investors. And with a dividend yield of around 10%, income investors are being paid a relatively high yield while holding the stock. Of course, like any lender, Ares Capital will always be exposed to credit market risks, but so far, the company has not announced any dividend cuts, and the portfolio performance remains relatively stable. So overall, Ares Capital could be an interesting stock for long-term income investors to consider. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.